Hi, Sean. Hi, Ole. Good to see you. Hi, everyone, and welcome to this Saxo's webinar in collaboration with CME Group. My name is Ida Johannesson. I'm Head of Education at Saxo, and I would be your host. And it is my pleasure to be joined by Sean Mulhern and Ole Hansen today. Now I'm going to share my screen, and we're going to go through the different slides. First, a brief introduction of Ole. Ole has been with Saxo since 2008, and before that, he was working in London for 20 years. He's the head of commodity strategy, and his role focuses on delivering strategies and analysis of the global commodities market. Ole is the author of the Saxo Weekly Commodity Update. He's a frequent guest on major global business TV networks, and he also regularly contributes commentaries to top-tier financial press. Next is Sean. Sean is the founder of Jacaranda Capital Partners, also highly experienced with over 30 years in global financial markets, with senior roles across Australia, London, and New York. He is now responsible for Jacaranda Capital Partners, an advisory and training firm based in Sydney and Singapore. He's also a regular speaker at international conferences and contributes to outlets like CNBC and Bloomberg. And Sean also currently lectures at universities in Singapore and a business school in Australia. Together, Sean and Ole would take us through an introduction of commodities and futures. They would talk about the benefits and risk of trading those products. They'll explain the type of commodities investment and show us some real-world examples. At the end, they would also go over their own outlook of where the market is going. We have reserved 15 minutes for Q&A at the end. Please feel free to type in your questions anytime during the hour in the chat. And if they're relevant, I'll direct them to the speakers. We also have a short survey at the end. We greatly appreciate if you could take a moment to provide your feedback to help us improve. Now, just a few things. The recording for the webinar would be available tomorrow on our platforms and website. And so, yeah, the recording would be available. And I guess now we can go to the disclaimer before we get started. Today's presentation is for informational and educational purposes only and is not a recommendation or an offer to buy or sell any securities. Investing in financial products involve risk, including the risk of loss. Commodities are classified as complex products in the EU, and so at Saxo, you are required to take and pass an appropriateness test before you are permitted to trade those products. Past performance is no guarantee of future results, and before investing, you should consider your investment objectives, time horizon, and risk appetite. And now, Ole, the floor is yours.
Thank you very much, Ida. And good afternoon and welcome everyone. Commodities is something that is an area that I've covered now quite extensively for the last 15 years. But prior to that, I was trading commodities very actively at my time in London. And it is a fascinating market, and it is also one that continues to spring surprises, but also creates great opportunities. And that's really what we're going to focus on today. I'm just going to have a little bit of a helicopter view to begin with, and then Sean will kindly give us some more detailed background what set commodities apart and then how to trade them. But I think it's good just to start off with the view of where we are and what has been going on so far this year. And looking at the performance table, as you can see, we split that into to several groups, primarily into energy, metals, and agriculture. I can see I got precious metals twice. That's obviously also just to highlight that it's been a phenomenal year for precious metals. But it also just gives you an idea about the kind of swings and price changes we can see within different sectors, but also within different from a commodities perspective as a whole, but also within different sectors. And as you can see, as we dwell into, there are several reasons why we see these major movements across markets. But ultimately, commodities are supply and demand driven, and that's why the commodity prices rarely lies, because really it is a question of available supply against the prevailing demand. And if there's a discrepancy, then prices will go up or down. Then obviously there are other things on top of that, but this is ultimately a market that gives us an idea about what is the supply and demand situation for different commodity groups. This is how the market's been performing going back to 2020. I just put that in as well because we just saw that very big slump back in 2020. We all know that was the pandemic that basically saw the world shut down for a period of time. Since then, we had a massive growth sprint with a lot of support from central banks. Interest rates were slashed, and then we went into a period where we suffered the consequence from the high interest or the stimulus, basically a period of high inflation, which led to some weakness and some lower demand. But generally, as you can see, we have now been in an uptrend for the last couple of years. If we move out a little bit further and go back for the past 60 odd years, then we can see that commodities tends to evolve in super cycles. Basically, we can have long periods where supply and demand is relatively matched, and that basically means that obviously you do have price swings, but you tend to not to have any big movements. What we see here is we've had two major super cycles since the 60s, and you can see the return that these super cycles generate over not years but decades are quite substantial. And the big question is really that we are asking ourselves these years is basically whether we are at the beginning of the next super cycle, which we are calling the green transition super cycle, simply because of the electrification of the world is adding upward pressure on demand for several key commodities that is important for this transition to be successful. And that is one of the key the anchors of that we focus on in the years to come. But the energy transition is not all of it. There are other potential bullish drivers that is underpinning commodity prices, because we have to remember that we have actually been through a couple of years where we've seen a slowdown in China. We've seen the property sector fall out of bed. And generally, when you look at commodity demand, around half of global commodity market demand comes from China. And when China is having a bad time, then it should reflect on demand for commodities. But we haven't really seen that, and that basically is part of that story is the transition that is providing some underlying support for several key commodities. I'm not going to read them all. You have the slides, so you can look into them afterwards. But there's a lot of these. We have deglobalization, which basically means that it's no longer a question of you produce where it's cheapest, you produce where it's safest, or at least where closer to home. That is not necessarily one that is going to mean lower prices, but probably higher price because production costs goes up. We have the defense spending, which has been a major theme since 22 when Russia attacked Ukraine. The decarbonization is a well-known driver for renewable energy infrastructure and EVs. The de-dollarization, central banks in looking to reduce their dependency on the dollar, and US assets has been moving into other assets, and in particular gold. That has been a major driver for gold in recent years. Demographics. I belong to a group that will retire within not too distant future. It's a very, very big population group we can call ourselves the lucky generation. We've been through decades with equity prices rising, with bricks and mortars prices rising as well. So we are retiring, leaving the workspace with money to spend, but obviously, so we're going to be spending, but we're not going to be producing, and that obviously adds extra pressure on those that are left to produce what is in demand, and that obviously that's where AI and robotics and so on perhaps can help, but it's adding some pressure. Population in the world is still rising. We're still seeing demographics or the urbanization, people moving from country to cities, that basically creates increased demand for goods and for commodities in general. So with all this in mind, we believe that the story for commodities is well and truly alive, and it is an important and interesting sector to be involved in. But again, it comes with a lot of risks and volatility, which you need to be aware of. And Sean will tell us a bit about that very shortly. But before we pass on the mic to him, just to give you an idea about just some of the futures fundamentals. We recently held, also with the CME, a webinar where we dwelled into the details of the futures market and how it was functioning. So you can look back to that one just to get some more details, but generally the futures market is really where all the price discovery starts when it comes to commodities, and these days also for many other assets, because it is where the liquidity and tends to be the greatest, and this is where all the interest from buyers and sellers tend to meet. Futures contracts are simple in the sense that they are, if you trade for instance gold, then the contract is a specific amount, so that you don't have to worry about. You only have to trade a number of contracts depending on the quantity or exposure you want to have. The expiry date is also fixed sometime in the future, and the delivery dynamics are also set in stone. So the only thing that you really have to worry about, or buyers seller have to worry about, is what is the correct value of this of the underlying of the futures that you're trading, and that's why it's so relatively easy to trade futures, because everything else is determined. The only thing you have to worry about is the price. That's a little bit of a simplification, but ultimately that's how they are constructed. These days there are futures on most different asset classes, anything from commodities and financials, which could be an S&P index future, on foreign exchange, and on interest rates. Could be anything from 3 month rates to long bond rates in the US. They are meant to be tools to use both for hedging and speculation, and it can help you diversify. If you have a stock portfolio, and you worry about the market direction, instead of selling everything out, you can actually sell futures against it. So at least you got the directional risk somewhat covered. They are trading on centralized exchanges, so you don't have any counterparty risk, and that has also made these contracts increasingly popular over time because of the big players that are in the market. Everyone can rest assured that the counterparty risk is very, very minimal, because it's all centrally cleared. And just finally, it is, as I mentioned, it is the place where not only speculators but also commercial users, they go to find price discovery. If you are a producer of a good and you want to sell it in a year's time, where do you go and find an idea about where the good will be trading in a year's time? That will be in the futures market, and that's why it is a meeting spot for many different types of users. And with that, Sean, if you'll take over and take us into the details of how markets works and how to use it. Thank you.
Thank you, Ollie. And a very good morning to everybody. I'm coming to you this morning from as close to the equator as you'll get in Singapore. So a little bit way away. I'm just going to try and share my screen. Hopefully you can see it by now, Ollie. Yes, you can. Terrific. So thank you very much, and welcome to the wonderful world of commodities. I think Ollie gave a very nice introduction about the performance that we've seen of the commodities year to date and a little bit of the history. I think one thing that's very important about financial markets in general is that all financial markets are volatile. The prices of all financial markets, be it currency, bonds, fixed income, equities, and commodities, they price every second of every minute of every day. So we see tremendous volatility across all asset classes. Commodities as an asset class is more volatile than the others. And I often put this chart up when I talk to students and other people, just to highlight the historical volatility of what I see like the major asset classes. And on this chart, I've shown the historical volatility of the US dollar and compared that to the equity index, such as the S&P 500. I've compared it to the Bloomberg Commodity Index, compared it to bonds, and then I'll highlight just an individual commodity, which is WTI crude oil. And as you can see, the volatility of the commodity markets is very significant. Now, that volatility impacts different participants across the financial markets differently. If you're a company or a corporation exposed to that volatility, it's going to have the potential to reduce your revenue or increase revenue, increase costs, reduce costs. It will have the potential to impact the value of the assets on your balance sheet. It can, in different cycles, impact your ability to access capital and credit from the banks and financial institutions. So corporations and companies are exposed to that volatility. If you're a trader and an investor, that volatility is a terrific opportunity for you to diversify risk. Volatility creates opportunities for traders. Volatility creates some arbitrage opportunities for traders, and we'll talk about some of them later in this presentation. So the traders and the investors are exposed to that volatility as well, as are banks. Banks are also exposed to volatility because banks, when they're providing services to their customer base, need to allocate capital for everything they do. So the more volatile the asset class, the more capital that the banks need to raise to service and facilitate that. So that volatility influences and impacts people right across the whole supply chain. So, with that, it creates opportunities for everybody. Just some general sort of information about the market for those that are not familiar with it. Most commodities are generally quoted in US dollars. The quotations for the commodities varies, and it varies depending on whether you're talking about the energy market, where it can be expressed in dollars per barrel, dollars per metric ton, or if you talk about gasoline in the US, they'll talk about cents per gallon, cents per litre. Natural gas can be dollars per million British thermal units, or MMBTU, dollars per cubic feet, dollars per cubic metre. When we look at metals, it can be priced as dollars per metric ton or cents per pound. Or if you're looking at the precious metals, dollars per ounce. And in the agriculture market, it can be expressed as bushels, pounds, or metric tons. So each different segment of the market has their own criteria, they have their own characteristics, and they have their own quotations. Where do we get the prices from? Well, we get them from a various number of market benchmarks. And benchmarks play a very crucial role in the commodities because not only are they used to service and facilitate hedging and trading, but they're also used as a reference point to trade in physical commodities when we're physically buying and selling those commodities. So where do we get those prices from? The prices come from three main sources. They can come from futures exchanges, such as the CME, that can launch a whole range of different prices. There are some regional exchanges, such as China and Japan, that also promote commodity prices. You can get things that are not traded on the exchange can actually be published through trade journals. So journals such as S&P Commodity Insights is another example of a trade journal that publish daily prices on a whole range of different energy products. And then you've got industry groups such as the LBMA, the London Bullion Market Association, who are responsible for publishing daily prices of precious metals. So depending on what the commodity is, you're going to source the price and you're going to get the price from a different area, whether it's futures exchange, trade journals, or industry groups. Let's turn our attention to the benefits of investing in commodities. And I think Ollie had a nice summary at the start of the different categories of commodities. And within the world of commodities, we can trade energy markets. So you can trade crude oil or refined products, gasoline, diesel, heating oil, jet fuel. You can trade electricity, you can trade natural gas, you can trade LNG, and you can trade carbon. When you look at metals, you can trade the whole range of industrial metals from aluminium, copper, lead, nickel, tin, zinc, steel, and now lithium. In precious metals, you can trade gold, silver, platinum, palladium, and in agriculture markets, you've got the soybeans, wheat, coffee, corn, cocos, and so on. So there's a whole range of different markets for us to trade in commodities. And when we look at the investment of commodities and the investors and the institutional investors in commodities, institutional investors typically have anywhere from 0 to 5% of their investment portfolio sitting in commodities. Now, if you look at what commodity offers as a tool, and Ollie mentioned this earlier as a way of trying to diversify risk, commodities have had a fantastic history and a track record of generating equity-like returns, meaning that they can really add significant value to any investment portfolio. What do investors like about it? The first thing they like about it is diversification, as Ollie mentioned earlier. It gives them an additional source of income. It gives them additional sort of revenue. Some commodities can actually have a negative correlation, such as gold, to stocks and bonds, meaning that when stocks and bonds are under pressure, you get a positive contribution from other areas. And we've seen a terrific example of that over the last 2 years in the performance of gold, where when other markets such as bonds and equities have suffered severe downturns or sharp corrections, gold, on the other hand, tends to perform quite well. So it really adds a lot of value to an institutional investor's portfolio in doing that. Some people view gold as an inflation hedge. Gold in particular has a very positive correlation to inflation. In times of high inflation, gold is deemed to be attractive. So you're getting inflation areas like that. And the other key thing I think that which is interesting about the commodity markets is they're liquid. Often people call commodities an alternative asset class. Alternative asset classes, in my opinion, are they're not the most liquid instrument, meaning it's not cost effective to be trading and transacting on a regular basis. Commodities, on the other hand, are very liquid, very transparent, and therefore very cost effective to trade. So they really do add a lot of value to the portfolio. And the chart that I've shown you here is a chart that's published by the World Gold Council that publish the historical returns of gold and compares gold to emerging market stocks, to US stocks, global stocks, US cash and US treasuries. And you can see over various timelines, whether it's 1 year, 3 years, 5 years, 10 years or 20 years, gold highlighted in the orange and even commodities highlighted in the purple color there have generated very significant and very good returns. So from the addition to an investment portfolio, there's a very strong argument to say that gold really does add some value to an institutional and a retail investor's portfolio. How do we invest in commodities is a question I often get asked.
One question, Sean, before you go ahead, you talked about commodity being a great diversifier and having low correlation with stocks. But can you tell us a little bit more about that relationship? Is it a static one or does it vary depending on the cycle? I guess the question is for the two of you, Sean and Ole.
Okay, I'll have a crack at it first, and then Holly can maybe catch in. I think it certainly does depend on the cycle. I mean, I think we mentioned if you look at there are certain events that occurred. Just go back as early as Liberation Day with all the Trump tariffs. The first rhetoric that came out of that market was sell everything to do with the US dollar, sell the dollar, sell the bonds, sell the stock market. Everything had a very negative response when Trump announced all these Liberation Day tariffs. Gold, on the other hand, went up. So from a buffer and investment portfolio was a classic example where people run for the exits. Gold tends to be one where they run towards it as a very nice safe haven asset. Ollie may want to have a contribution to that comment as well.
Yeah, that's absolutely correct. And what we also see, what we sometimes do see, if there is a sudden spike in volatility in the market, then we have very short period of times where everything is equally, where everything does the same, and that's simply because normally if there is a big uncertainty involved in the market, especially if there's a big move in the equity market, then the first thing you think about as an investor that is to reduce your risk, and then you start looking for opportunities next. But in that phase of reducing risk, then obviously the most elevated positions are also the ones that tends to get hurt the most, because at that time you're not piggybacking, trying to see which one will do well. You're just generally reducing risk. So sometimes we have, but that also creates opportunities, because as Sean mentioned, we've had situations where gold also initially had been falling together with others, even though it should be gold positive, and that's simply because of the deleveraging that's unfolding in the market, where hedge funds and others are just having to reduce risk. But as soon as markets stabilize, they'll look for the next opportunity, and then that's where you quite often see a very strong rebound in those that were only reduced simply because risk had to be reduced. So it speaks. That makes it something that makes it very interesting to follow as well.
So it can move in the same direction, but it tends to be short-lived. Okay. Back to you, Sean.
Okay. Can you see on my screen, Charlie? Yes, you can. Great. So there are various ways investors can get access to commodities, and I've just highlighted several of them here. The first one is equities, and when we're trading in equities, it's all about stock selection. We can invest in commodities by physically buying the physical commodity. And there are different characteristics associated with that. We can invest in commodities via futures, and we can invest in commodities via ETFs. So what I'm going to do now is just spend a few moments just talking about each of those and some of the characteristics associated with all of those techniques in potentially getting access to the commodity market. And the first one we'll look at will be equities. When we want to get access to the commodity markets, investors can go and get access to commodities by purchasing shares of public listed companies in a particular field. If we like energy and we like oil, we can go and look at companies like Shell, BP, ExxonMobil. If we like industrial metals and we want to get access to the industrial metals, we can go and buy some of the leading mining companies, such as BHP or Rio Tinto. If we like gold mining companies, we can go and buy Newmont, the largest gold producer in the world, Barrick, and we can also buy some smaller junior gold miners. Or if we want the exposure of traders, then we can get exposures of traders by looking at a company like Glencore that's got a diversified pool of businesses across all those areas. The thing about equities is just not the play on the commodities. When you're buying shares in publicly listed companies, those shares are going to be influenced by the broader equity market. So if you see strong increases or decreases in the broader equity market, these companies tend to go along for the ride. So and you may have a situation where, you know, they may not go as up or down as much, but they sometimes have a low correlation between the commodity and what the broader equity market does. The other thing about equities is that the equities perform well based on the management. Does the management have a historical track record of performing? Do they have a good outlook in terms of what they're going to do? Do they hedge the price risk? Some people buy companies of commodity producing companies where the company's got a very strong active hedge program, meaning that if there's an increase in the price, those companies won't necessarily benefit entirely because they've mitigated some of the risks associated by hedging it away. And then how are they exposed to event risk, things like environmental and COVID? So companies perform differently than the actual broader equity market. And so if you look at a comparison, what I've got down here, it's a 5-year comparison of what's been the performance of the gold miners, such as Newmont and Barrick. How has that performed to the junior gold sector, which is in the red line? How has that performed against the gold futures, which is in the white line? How has it performed against the Standard & Poor's Commodity Index? And so you can compare and contrast all the performances of these. And if you look historically, gold miners generally underperform the broader equity market as an equity stock. So the commodity itself may perform well, but the miners may not do so well. This year's been a bit of a standout year for it. And I'll highlight it in the corner of the chart here. If you look at the year-to-date performance of, you know, all of those different variables, you know, gold futures are up 32% year to date. It's now 40 as of this morning. Gold ETFs are about 32% up. Newmont, the largest gold mining company in the world, is up nearly 99% year to date. The junior gold sector up about 87% year to date. Barrick up 71% at a time when the Standard & Poor's Equity Index is up about 9%. So you can see you're getting a very diverse outcome depending on the stock to pick and depending on the investment category that you choose. So when we look at equities, it's important that, you know, picking the right company will have a very big impact on the ultimate return. So that's equities. We can invest in commodities physically. Now, that meaning you can buy it, hold it, store it, and insure it. Some commodities are easier to do than others. Precious metals or gold is probably the simplest and the easiest way to do it. You can go and buy a 1 kilogram bar of gold, which is about the size of your iPhone, worth about $150,000 at current market rates, and store it at home. Very easy to do. You can buy jewelry, you can buy coins as a way of physically investing in gold. If you wanted to look at the industrial metals, it's a little bit more difficult. You've got to store that metal in warehouses. You've got to put it in locations. It's important characteristic to know, is the metal that you're buying approved by the exchange or is it not approved by the exchange? If you look at the energy market, storing a barrel of oil is very different to storing a kilo bar of gold. So, and likewise for agriculture, where you've got to put them into silos, and by definitions, you know, a lot of agricultural commodities are perishable. So they may not necessarily be good for the long-term thing. So getting access to commodities physically is possible, but it varies depending upon whether it's precious metals, energy, industrial metals, or the agricultural markets. The other way we can invest in commodities is through futures. And I think Ollie has got that nice little summary that he put at the front of the presentation today that categorize the different types of commodity markets that were there. In the energy market, we can get access to futures in crude oil, refined products, things like heating oil, gasoline. You can get access to natural gas. In precious metals, we can trade futures in gold, silver, platinum, and palladium. And in the industrial metals, we can trade copper and aluminium. And agriculture, you've got corn, soybean, and so on. The key thing about futures markets is futures markets are extremely good. Futures markets are liquid, transparent, and efficient markets. You know, the statistics about the value of the global commodity markets, it's in excess of $140 trillion. It's an actively traded market. Futures markets offer you a range of ways to trade the market. You can trade outright futures, you can trade options, you can trade spreads, you can trade location differentials, and you can even trade indices. So there's various products that the futures exchanges offer. The prices available that you get from the futures market, they're liquid, they're transparent, and easily accessible. Data is published daily. They give you information about the price, the high, the low, the last, the bid, the offer. You get a sense of the trading activity, how much volume has been traded, what's the open interest or the volume of trades that have occurred over a period of time. So you get lots of information when we trade futures, and that transparency and the ease of data gives investors confidence to use that market. It's not something that's opaque and difficult. It's liquid, transparent, and you've got readily available information and data that gives you confidence to transact and execute transactions whenever it's appropriate to do so. You can invest in commodities via an indices. Now, a commodities index is basically a basket that consists of not an individual commodity, but a series of commodities. They can consist of energy commodities, metals, industrial metals, agriculture commodities. There are over 150 different indices that you could trade if you wanted to. The most popular indices are the S&P GSCI, Goldman Sachs Commodity Index, which is previously referred to, or there's a Bloomberg Commodity Index, previously known as the Dow Jones AIG Commodity Index, CRB Index, and then there's a Ricky Index, which is run by a commodity veteran by the name of Jim Rogers. These indices can be traded also on futures exchanges. Now, you can see here that the relative performance of all of those indices are different. They're not the same. If you look at a 5-year time horizon, this is the relative returns that you've got from all of those different indices. And the reason those returns are different is that each index has a different weighting of commodities. If I highlight the third column to the right, the GSCI, you'll notice that the energy component in the GSCI is the highest of its major competitors. In contrast, the agriculture component on that is probably the lowest compared to its major competitors. So in times when the energy market performs well, the GSCI performs well because it has a bigger weighting. In times when metals perform stronger, you may find markets such as the CRB or the Bloomberg Commodity Index may perform better because they have a higher weighting in there. So when we're trading in indices, it's important to look at the configuration of that indices to ensure that the weighting is consistent with the view that you have about the market. So that's investing in indices. We can invest in ETFs, exchange traded funds. Now there are over 150 different exchange traded funds that you can trade. We can trade exchange traded funds in equities. We can trade them in commodities. We can trade them in a whole range of fixed income securities and so on. ETFs can be backed by physical commodities such as gold, or they can be backed by futures. And it's important when we're trading ETFs to know what's backing that ETF. In gold, probably the most successful ETF is the SPDR ETF that trades. It's got about $38 billion of investment money under management. The gold SPDR ETF is now the third largest holder of physical gold holdings in the world, just behind the European Union and the US Federal Reserve. So as a contributor to the market, the ETFs is a significant participant in the gold market. There are ETFs in futures, in oil, which are backed by futures. There are ETFs in agriculture, which are less popular. And there are ETFs in base metals, which are also less popular. The returns on ETFs are going to be impacted by management fees. The returns on ETFs are going to be impacted by the transaction and rollover fees. So if you have got an ETF that's backed by futures, there's significant transactional costs associated with rolling those futures contracts to maintain your position in that fund. And that's also contributed to what's the shape of the forward prices and what's the shape of the forward curve. So investing in ETFs is another way that we can get access to the commodity markets. I'll spend a few moments now talking about some different trading strategies, because when we trade, you've got a question?
Yeah, I just have a question, Sean. For a regular investor, what are the pros and cons of using ETF versus direct commodities exposure, for example?
There's not the direct commodity exposure. So the difference between, say, buying physical gold bars and an ETF, the real difference is just the management fee. because gold-backed ETFs are physically taking the investor's money, purchasing bars of gold, and storing and insuring them in appropriate sort of storage locations, such as London in the Bank of England gold vaults. So the price performance are relatively consistent because they're backed by the same asset class, but the ETFs will lag a little because of the management fees, which they have. And those management fees are very transparent. You know what you're getting. It's just a matter of people's preference of, do they prefer to have the physical gold bar sitting in the vault for themselves, or would they prefer to go and invest it through an ETF that way? So there's not that much difference in the returns. And if you look at the earlier charts, if you plot the price of gold futures versus gold ETFs versus gold, I think I've got it here. I'll just go back and show you if I can. If you look at the earlier chart, I've got the gold futures versus the ETF. They're very similar. So you don't get significant differences. It's just a matter of what the investor preferences will be.
Okay, back to you.
Okay, thank you. Let's talk about some different trading strategies, because I think the beauty of the markets. Can you see my screen okay? Yes.
Yes.
The beauty of trading commodity markets is that there's so many different ways that we can actually trade the market. The first and easiest way to do it is we can just trade directionally. If we like the market, if we think the price goes up, we go long. If we think the price goes down, we short it, we sell it. So directionally trading markets is something that's very simple and easy to do. The second way we can trade markets is that we can trade what I call time and curve spread. So it's trading the shape of the forward curve. Bond traders in the money markets and bond traders around the world are very active in trading the shape of yield curves. They're very active in trading the spreads between, say, the 3-year government bonds and the 10-year government bonds, or the cash rate and the bond rates. We can do the same in commodities. We can trade the shape of the forward curve. And it's very commonly used by the professional traders, where they can trade seasonality, where they can trade the difference in prices from summer to winter, or they can trade calendar spreads, or they can trade different parts of the curve. So trading the shape of the forward curve is something, like you can in fixed income, is something that we can also do in the commodity markets. The other way we can trade markets is relative value. I mentioned before, volatility creates opportunities. Sometimes there are arbitrage opportunities associated in the commodity markets. When you get bouts of an arbitrage opportunity, is basically a dislocation in the price from one versus another. Sometimes the price in a physical commodity can be dislocated from the futures market. That gives rise to a trading opportunity where you can trade that arbitrage, where there's a dislocation between the cost of the physical commodity and the cost of the futures market. We can trade spreads in commodities, very commonly traded in the energy market, where you can trade the spread differential between crude oil and gas oil, crude oil and heating oil is another way that we can do it. Or we can also trade ratios. We can trade ratios where a lot of people often trade ratios in gold and silver, where they think that both of them are going to perform well. I think gold will perform better than silver, and so I'm going to put an investment bet down that says that gold will outperform silver, so I'll trade that ratio. So I can trade ratios and relative value trades as well. And then the final thing that we can do in commodities is we can also trade locational differentials. Is there a price difference in that physical commodity in one location versus another for exactly the same commodity? And we've seen tremendous examples of that recently, where we've seen copper and gold have seen significant dislocations in prices from London versus New York in response to the tariffs. When we're trading transactions, the important thing to think about is our execution, making sure that when we execute that the market's liquid. I mentioned futures markets are terrific because they provide lots of information and transparency about the data in the market to know that it's liquid. Liquidity is the cost effectiveness of transacting. Liquidity varies by asset class. So the liquidity in the foreign exchange market is different to the liquidity in the bond market, which is different to the liquidity in the bond market, in the commodity market. Liquidity varies within the asset class. So in the foreign exchange market, the liquidity of the euro versus the pound sterling is different than the Japanese yen versus the Australian dollar. So it varies within the asset class. It varies within the fixed income and government bonds, governments versus corporations, different liquidity. In commodities, we have different liquidity, crude oil versus gas oil, gold versus silver. Liquidity varies by geography. The liquidity in Europe is different to the liquidity in the US, which is different to the liquidity in Asia. All of these are consequences of when we execute a transaction. And traders analyze the liquidity of the market and try to transact where it's the cheapest, where it's the most cost effective, where you're getting better value for dollars. And so we get lots of information that we can help, particularly through futures, that help us make informed decisions about where to trade and why. I mentioned the impact on markets. This is what happened in the copper market earlier in the year. Trump's tariffs were going to be imposing a tariff on copper, sent the prices of copper completely crazy. The price in copper in New York jumped dramatically. At the same time, the price in copper in London went down. We saw a big dislocation in spreads. People were rushing to get gold out of Europe and trying to transfer it across to Europe, to the US, before the tariffs hit. That had a major impact in the differentials between exactly the same commodity, and it caused a trading opportunity. We saw it again in gold just recently. The gold market, people were worried about Trump putting tariffs on gold from Switzerland to the US, saw a significant dislocation in the price of gold in London versus the price of gold in New York. These are transactional trading and locational differential transactions that people get involved with. So they're all the different ways that we execute. One of the things I think that's important to think about when we execute is when we are ready to transact, we do our research on the market, we decide which market we want to trade, we decide the type of market we want to trade, then we go to trade. So what are some of the tools that can help us to transact, to know that we're doing it in a cost-effective and an efficient way? Well, the first thing we look at is market conditions. What's the macro situation like? Is it extremely volatile? Are there event risks occurring? Are there things that are going on in the market that's causing extreme bouts of price volatility? What's the level of inventories in the system? Do we have inventories in the market that is, the market's either got plenty of inventory to deal with a rainy day, or they don't have enough to deal with a rainy day? The other thing we look at is what I call the market pulse. It's another word. There's a series of reports called the Commitments of Traders reports, and I'm going to get Ollie to talk a little bit about that just in a few moments, because the Commitment of Traders reports give us an indication of what's the current position of some of the actual transactors and traders. Ollie, do you want to talk a bit about that?
Yeah, absolutely. And just leave the slide there, Sean. As you mentioned, the cut report is basically the reason why it's interesting is because the futures market is really a zero-sum game. For every long, there is a short, and that basically means that you have a number of longs and number of short in each individual market. That basically accounts to what we call the open interest. That is the combined sum of long and short positions. What we then have in the commodities sector, in the futures market, and especially in the commodity space, is the reporting requirements that the major holders of positions need to report once a week to the authorities what they hold in terms of positioning. And that leaves us that gives us a good snapshot of how the market is split up between various major users. In commodities is obviously on one side the commercial side of the equation. Then we have the managed money, which tends to be speculators, hedge funds. Then we have a group called swaps, which tends to be banks offering hedging activity for clients. And then we have the final group, which is others, where you kind of throw in the rest that you can't qualify, but they tend to be quite speculative in nature as well. And that leaves us basically with a weekly snapshot of the market. And Sean, if we move to the next slide.
Yes.
And that basically means that we provide a weekly summary of all the different numbers that we extract from the CFDC in the US, and that basically leads to this table that I produce every Monday. Why is that interesting? Well, it is interesting because simply it gives us a good idea about, first of all, the strength of an underlying trend. How big is the position? How well established is the position? How big is it relatively to recent history? And with that in mind, it can become a bit of an inverse or reverse indicator if the positioning starts to become quite elevated, either long or short, and we suddenly have a change in the fundamental or the technical setup, then we know that potentially could be a major correction coming in the market, and that's one thing we can keep an eye on. But generally, just a good feel about the appetite for the different commodities. And obviously, I just highlighted in yellow on the right-hand side. I put that out in my report on Monday. It just struck me, but it's actually, we have seen it even bigger than this. Right now, $60 billion or $61 billion worth of exposure is held in the as a net long in the gold market. That's out of a total position of 129 billion if you look across these 27 major futures contracts. So nearly half of the exposure is currently in gold, and that does obviously tells you a story about a market where the trend is has been very strong in an upward moving direction, but and one that has not really triggered any major corrections and thereby reductions in position. So it is quite elevated right now, and that basically just tells us that for every 1% move in the gold price, someone out there is making or losing $600 million. So it is a big position, but it was actually even bigger a year ago. So so yeah, that's just a quick snapshot. If you if you just go back to the previous page, there's a few charts on the right where we basically just show the long and the short. And what is we find interesting right now, among others, is the fact that there's almost a zero position in WTI crude. So basically, traders are equally split between whether it's going to go up or down, and that will eventually obviously create some activity in the market because. In the hedge funds, they are put in this. They're put in the world to make money, and that basically also means that I think that's another characteristic why we follow the
Sorry, Ole, we are no longer able to hear you.
I just lost Ollie too.
Ole?
track of what kind of position they have. Yes.
Sorry, we couldn't hear you for a while.
Oh, okay.
Yeah, now you're back.
You lost the last 2 seconds. Your last 2 sentences.
Okay, good. But I've said most of what I want to say. But generally, just managed money accounts are interesting to follow because they are very receptive and very reactive to any changes in the outlook. And if you then combine that with the kind of positioning they're holding, that gives you a good idea about what kind of incoming movements we may see in the markets. So so that's why I find it very interesting. And I think with that we probably have come to the end.
Yeah, if I could just add to what you said on that thing on the commitment of traders report, Ollie. I mean, I think for those who want to get access to it, I mentioned the futures exchanges publish this data. The way in which Ollie presents it in his chart here and the slide there, I think is infinitely better than what you're going to get if you go to the exchange. The exchange has the information, but I think the way in which Ollie has presented it here, for those looking at it, I'd encourage you to get his weekly report. Of, this is the market pulse. It gives you the feeling as to how do people feel about the market. What's the market? Are they generally bullish? Are they generally bearish? What's the expectation? What's the market pulse? Is what I refer to. And I think the visibility of this and what you see here, and I think if Ollie puts that in his weekly report, I think that's probably is one of the better ways of highlighting it visually that I've seen from various other commentaries, and particularly from the exchanges. So I think that's just not a plug for Saxo. I think it's genuine feedback. So no, I think it's excellent, Ollie. So thank you.
Good. Will you take the summary, Sean?
I'm happy to take the summary. Look, I think I mentioned at the start of my very first slide that the financial markets are volatile. That volatility is not going away. If there's one thing for sure, the markets will remain volatile. Currencies, commodities, bonds, everything is going to be volatile. The trick is, how do you manage that volatility? Commodities, I think if they're not in your investment portfolio, are a very attractive asset class to add to the portfolio for some of the various sort of diversification and different types of risk rewards that you're going to get from associated with that. If you do want to invest in commodities, there are multiple ways of doing it. Shares, but be wary of how you do the shares by choosing the right stock. You can trade physically. Just think about the logistics of how you're going to physically store that commodity. Futures, probably the easiest and the most efficient way of doing it. Or you can trade ETFs. Each of them have their own pros and cons, and each of them have their own sort of payouts. And you guys will, and I'll put, I think, in the appendix here, just given some other examples where you've seen various returns from different equity versus commodities versus other markets, just to help highlight and help you on that journey as you go along. But thank you guys for joining, and we'd welcome any questions.
And before we do that, Sean, I think I just want to stay on that, what to look out for. If you just go back to the slide, because I just want to highlight one thing. If you go back to the big table, that's exactly it. I circled one area on the right-hand side where it says forward curve, and I think that's really important. And Sean mentioned it. Basically, understand what's the forward curve look like, because it really it gives you an idea about what kind of return you can achieve in going forward. If you have a market where the spot price is higher than prices further out, that basically means a market that is perceived as being tight. Just imagine that you're long a contract where you bought at the front end. When you need to roll that to the next, you are basically selling an expiring contract at a higher price than where you're buying the next. That's giving you a positive roll yield, and that's basically over time will either act as a drag or act as a tailwind on the market. And just to mention one of the major ones, if we look at and wonder why it has been a very tricky one to trade. The table disappeared. If you put back up again, take natural gas as an example. Right now, natural gas in a year's time from now is basically trading what it called contango basis, so forward prices are higher. That means natural gas in a year's time has to trade at least 28% higher than where prices are today for you to make money over the next year. And that's a massive headwind. And that's why something like futures market in natural gas is really best meant to trade on a very short-term basis, because the long-term drag from the contango is playing a major part on your return. You can see right now as well, the agricultural space is well supplied. That basically means as well prices are lower or higher in a year's time compared to current market. Again, that's giving you something to a headwind. Where the opposite is the case, something like coffee, we have tight supply. So if prices in a year's time is exactly unchanged from where they are today, you would have made 16% just by sitting on a long position. If you look at some of the energy markets, there are cases there as well where the market is in what we call backwardation, basically meaning that that the price will be working in your favor. So try to understand, Google, look it up, contango backwardation, understand what the curve means for your investment. This was a major drag for almost a decade, up until 2020, where for that decade almost, if you bought an ETF investing in a commodity index, you would actually realize a lower return than what the underlying investment or the underlying positions told you that you should have made. That reversed in the last few years, where we're seeing some tightness start to emerge, and that has also attracted more appetite for commodities from investors that may not necessarily be able to or allowed to invest into something where you have too much of a negative carry, as we call it.
Yep.
All right, I guess we have time for a few questions. Marcus is asking how to use commodities to hedge against inflation.
I can start with that. I think I think we just have to look at how commodities have performed over time. We have to think about that the commodities are tangible assets. That is not, if prices are rising in the system, and you can see how the value of other instruments struggle to keep up with the inflation, but because it's tangible, it's a low supply area. That basically means that historically it has proven to hold its value. Some commodities are better at times than others, depending obviously whether you have inflation together with growth, or you have inflation together with a slowdown. We're seeing a little bit of sign right now where we are seeing perhaps a slowdown in growth, especially in the US. And we're seeing inflation staying relatively elevated. That means something like gold will potentially do better than perhaps silver, because that's an industrial, semi-industrial metal as well. But generally over time, we do see that they tend to perform in line, or perhaps even better than inflation. That just remind you that if you look at what the value of an ounce of gold was 2,000 years ago. What you could buy for an ounce of gold back then, you can buy the same or probably more today, 2,000 years later. So basically, it has maintained its value.
Mm.
Do you want to add anything to that, Sean?
No, I think it was. Ollie answered it very well. I mean, I think gold is often the beneficiary in times of high inflation, but gold's a beneficiary not only in times of high inflation. It's a beneficiary in times of as a safe haven when other things are going geopolitically wrong as well. So gold generally gets put into that bucket of saying it's an inflationary hedge, but it's a few other things on top of that, which I think is one of the reasons why you're seeing it perform as well as it has done. But I think Ollie answered it very well.
Okay, John is saying, I know that you cannot provide any recommendation, but what commodities are you currently considering for your portfolio? And I guess you can go to the two of you.
Well, I think it probably shines through what we've been talking about, what we like in particular right now. If I look personally, I view obviously. I'm obviously a little bit worried that we've seen a very, very strong run already across the precious metals. Remember the table we showed at the beginning where we have some significant performances already this year. But we also have to remind ourselves, why is it so? Why are people buying into a metal that is it's a debt investment? Because it doesn't give you any performance, it doesn't give you any interest rate or coupon. But it is simply that there are so many uncertainties right now across the world, and until we get some solutions to some of them, then investors will continue to look into gold. And as interest rates are expected to come down, then also the opportunity cost of holding a commodity is coming down, because you have to remember, if you bought gold and the alternative was buying a secure government bond, then where you receive an interest, and that interest you received as an alternative to the metal was basically the opportunity cost you had. When that comes down, that opens up the for other markets. And I think the whole electrification, we're talking about this electrification and going forward and how it impact. I think there will be positive stories for natural gas, for copper, for aluminium, and for some of the other metals that are involved in the conducting of power, but also the building of the infrastructure that ensure we have all the power that is going to be needed going forward. So this is really where I'm focusing right now. Sean?
I think I'd add to that, Ollie. I think that you can sort of put them in short, sort of medium and longer term baskets. I think if you look at some of the industrial metals, I think that they've been under a little bit of pressure recently due to the fact that we've had slow economic growth. We've had lots of inventory, but then if you look down down the timeline, there's particularly copper. You mentioned copper before, that there's the expectation that there could be potential shortages of copper that can be short of what demand's going to be as we start to recover. You will find as a recovery stage, which every economy is going to recover if it's not going to go, doesn't go down forever. So if you start to see recoveries, some of the industrial metals will perform well. You've seen so I think it's like copper and aluminium in particular. If you start to see upticks, they'll go very well. A lot of people look very closely at the China commercial real estate market to see if that's a good barometer for some of those industrial metals. That's been quite soft. If we start to see an improvement in that, then I think you'll see the beneficiary come through with some of the industrial metals. If you look at the energy market, before this week, I think the energy market was considered by many to be fairly soft. There's slow growth that was a dampener. And then you had plenty of inventories around, which is a dampener. Natural gas is a similar situation, but it remains vulnerable to event risk. So in as much as you've got that macro sort of economic view saying slow economic growth, lots of inventory, not too much demand, doesn't sound good for the energy sector. It can turn on a dime with the geopolitical situation, which was just seen this week. So I think that they all remain vulnerable to something, but some more than others, particularly energy.
I think we have time for one last question. I'm going to pull up the QR code for the survey, and then you can just answer the question at the same time. And the question is from Lana, who's asking, how long does a bull trend in gold usually last?
Well, if I look back at the last 25 years, which is the time where I've been involved with commodities primarily, I would say 3 to 4 years without any major big corrections. And I suppose the one we are currently in started back in well, it already back in 2003. So we're a couple of years into that one. So perhaps potentially another year to run. What is obviously slightly different this time around is the strength and the force and the speed with which we have rallied, which potentially could mean that it exhausts itself sooner than we have seen in the past. But then again, there is a reason why we're up here, and as I mentioned, as long as those reasons are not resolved, then investors will continue to look for safe havens.
Anything you'd like to add to that, Sean?
No, I think, in fact, I just pulled up the chart that Ollie actually referred to earlier on, where he's got all the, I guess, the history, which tells you a wonderful sort of a bit of a timeline of what those super cycles have looked like. And I think looking at that one there, and you can sort of go back to, I mean, it's very difficult to predict what's going to happen, but I think history can show that some of these things can last a long period of time. So I think we're in a very uncertain time at the moment, and that uncertainty is not going away, but I just don't know how long it's going to last for.
All right. Thank you very much, Sean and Ole, for your time. I really appreciate you spending time with us today and sharing your knowledge. Thank you to the audience, and we hope to see you soon. And I'll pull up the QR code again. Have a great afternoon, everyone.
Thank you, everyone.
Thank you very much.
Do you want me to log off now, Ida?
Yeah, you can do that. Thank you,
Okay,
Sean.
thanks very much.
Bye.
We'll be in touch. Thanks again.
Bye.